let's look at this last element, the cost of equity. We talked about cost of debt after tax, the cost of equity, preferred stock, which pre-tax and after tax are the same thing because there's no tax adjustment. There's also no tax adjustment for our cost of common equity. Well, how might we go about estimating a cost of common equity? Unlike bonds, we don't have to pay dividends, but we know, of course, that shareholders expect us to pay dividends at some point. If we weren't going to pay dividends ever, the stock would have no value if there was no way to get your money out of the stock, or no one would buy it from you if they couldn't pay dividends. No one would buy the stock. So how might we go about solving for the cost of equity? Well, let's use this model, our pricing model for a constant growth firm, which said that the price of the stock is equal to the dividend that we expect to receive at time one over the cost of equity minus the growth rate. And if we use that model, in fact, to use this model, we have to estimate the cost of equity. Instead, we can sort of reverse engineer this and solve for the cost of equity. When we do that, we get this model down in the lower left-hand corner. The cost of equity equals the dividend over the price, or the yield, plus the growth rate. So if we assume that the dividend is 2%, the stock price is $40, and the firm's growing its dividend, it plans to grow its dividend at a 7% rate, we plug those amounts in to 47%, and we get a cost of equity of 12%. Now, that's generalized. Let's talk about the cost of retained earnings. Okay, this retained earnings have a cost. Well, obviously, if we sell new shares, the purchasers have to pay something. Are they paying anything, or are shareholders paying anything if we're using retained earnings to fund a project? So is there a cost to retained earnings? And the clear answer is yes. There has to be a cost to retained earnings, because if retained earnings wasn't going to earn anything, if it wasn't going to be invested to earn anything, we could pay out those earnings to our shareholders as dividends, and they could take the money and go out and invest it and earn a return. So if we're going to hold that money rather than hand it over to the shareholders, we must be working under the presumption that we can earn a better return than the shareholders would be able to earn themselves if they got the dividend. So the cost of retained earnings essentially is exactly what we saw earlier. This equation here, the cost of common equity in the form of retained earnings is equal to the yield, D1 over P0, plus the growth rate. Okay, and we solved for that just a moment ago. That's exactly what we calculated. That's our 12% that we calculated a moment ago. In fact, if we have to raise additional capital, the cost is a little bit higher than it is for retained earnings. We have to sell additional shares. And the reason is that, just like for preferred stock, there are flotation costs involved in issuing common stock. So if we issue additional common stock, and we sell it at the current market price of P0, okay, we're not going to get the whole amount. We're only going to get P0 minus whatever the flotation costs are for new stock. So the cost, and we actually use two different symbols here, KN for the cost of new, KE for essentially the cost of retained earnings. So this is our retained earnings, and this is new common stock down below. Let's consider the situation where the firm is paying a $2 dividend next year. The price of the stock is $40, but in order to issue a new share, we're going to have to pay $4 per share in flotation costs. The cost of new equity, rather than being the cost of our retained earnings, was 12%. The cost of new equity, because we're only raising $36 rather than $40, the cost of new equity ends up as 12.6%. So the cost of new equity is greater than the cost of retained earnings. So let's consider the both of these, the cost of retained earnings and the cost of common equity. We'll describe with this equation, D1 over P0 plus G, the cost of raising new common stock, new equity capital, is adjusted by the flotation costs.